What are the best tax deductions for your investment property? A question we get asked all the time. For answering that today is Kim Quach from Duo Tax Quantity Surveyors. Hello, Kim. Welcome.
Hi, Anmol. Thanks so much for having me today.
No worries. Welcome back, I should say. We've had you on for the first time discussing depreciation reports, which was a very well-received podcast. And here we are back again talking about the best tax deduction. So let's get right into it, hey?
Yes, thanks so much. Yes.
There you go. So can you, before we start actually, if you want to just introduce yourself and your company as well?
Oh, sure. Yes. So I'm Kim from a company called Duo Tax Quantity Surveyors. So we're a company that's been around for the past 6 years and headquarters in Sydney, but we service clients Australia-wide. And we specialize in preparing what's called a tax depreciation report. So basically, it's a schedule that helps property investors or landlords claim the loss in value their physical asset, their investment property, loses each year. So it's a form of negative gearing, and it does help a lot of investors make sure their cash flow is on top notch, especially in today's day and age as well.
Absolutely. And this is a report that lasts for 40 years, doesn't it? You only have to get it done once, and it allows you deductions for the next 40 years.
That's correct. So brand new properties get a massive benefit from it. They do last quite a long period, 40 years.
Which is why you see a lot of investors wanting to buy new properties, because they can have a lot of that depreciation claimed up front for providing those tax benefits. So there you go. So let's talk about this, as we were talking offline about one of the from a renovations point of view.
Yeah.
How does that work?
Yes, so one of the a lot of people who do come through to us do ask us, one question is, if I had, say, $5,000, what are some of the key items that I would be beneficial for me to claim deductions on in terms of my renovation? So a lot of the first-time investors who doesn't have a lot of cash flow or a lot of capital to renovate or complete a massive renovation, they've got a bit of money set aside to improve properties, the quality of them. So if you want, I can go through with you like the top 5 that we have.
Yeah, let's talk about the top 5. I'm actually just having some technical glitch here, but let's keep going. I think I will catch up on this one. My Facebook is just having some issues, it looks like, but let's keep going.
Yeah, no worries. So the first, and I think the biggest item that we do have, a lot of people do claim quite a lot in advance, is lights. So like Anmol, a lot of people who don't have the money up front, they'll be buying existing properties where it's a bit more older, a bit more of an older style. And the lighting would have been those traditional screw-on light bulbs. So a lot of properties now, the energy efficiency of LEDs does mean people who invest, say, $2,000 in updating all your lighting actually is able to claim the cost of lighting over a 2-3 year period for them, because lighting is technically supposed to only last a few years there. So that's one way. Instead of $5,000 say in paint work, if you were to spend, say, same amount, $2,000-$3,000 revamping a property in paintwork is classified as capital work, so it actually depreciates over a 40-year period. So investors don't actually get the money that's in return to paint the house as they would to install brand new lights. Another thing that we come across is people who need to relay flooring. So there's quite a lot of options nowadays. You can either get tiling,
carpet, timber, where do you go?
Vinyl timber as well nowadays, floating timbers. So dependable on the flooring type. So if you had $2,000 to relay tiles is effectively depreciable over a 40-year period, right? However, if you were to lay, say, timber or floating timber down, floating timber or vinyls, those type of flooring has a depreciable life of expectancy of 12 years. So that $2,000 that you spend will actually get accelerated and depreciate a lot quicker by laying down different types of flooring within a property.
Interesting. So typically when you are owning a property from anywhere from 7 to 10 years, you want to be able to spend money on those items that you can depreciate while you own them. And the comparison here is quite, wow. So 40 versus 12 years for tiles and vinyl. There you go.
That's right. So another big ticket item that we do see is stovetops as well. So stovetops generally is about $5,000 to purchase, and they generally last about 15 years as well. So the depreciation of it, you know, comparable to if you were to install new bench tops. Or revamp, you know, a lot of people like to put new islands or kitchen islands into their kitchens now. So when you think about where your dollar is going to be spent, you know, it does add up when you think depreciation over 15 years comparable with depreciation over 40 years. If you're not planning to keep this property for a long period, then you need to decide, like, where's the money going to be most effective as well. So yeah. Exactly.
And is there a obviously one way to find out is to contact you guys to find out what the difference is, but is there like a universal chart somewhere that can show you that typically, you know, a tile is depreciated over a 40 years period and X, Y, and Z over so many periods?
Oh, of course, yes. So the ATO, we have a guideline that we have to follow by, and it's the guideline that's presented to us by the ATO. So the ATO will give us depreciable asset effective life, and that basically is a table. It ranges from, you know, your rental property all the way to if you had an office or a manufacturing plant. And they give us a guideline on how much depreciation or effective life each asset is. So let's say the tiles, for an example, if there is no effective life for a tile will then be classified as a capital works. And capital works just basically means it's part of the structural component of a building, and it depreciates over that 40-year period instead of, you know, if it was actually carpet over an 8-year period. So yeah, so ATO does govern that, and it's free for everyone to use as well. So, you know, if they're doing their due diligence, trying to see where the bang for their buck is, and they had a few options by builders, if their builders were saying, you know, do you want to go with tiles, or do you want to go with carpet, or do you want to go with floating timber, then they can always have a bit of a research and deep dive into what would be the best options available for them, or give us a call. We're happy to.
Yeah, that's easy, I think. Contact you. But wow, there you go. That's quite so definitely do your research before you start renovating an investment property to find out where you're going to get bang for buck when you are spending, if you've got a limited budget, where you can get that sort of maximum return from your tax write-off perspective.
That's
so there
right.
you go. So we've discussed painting versus lighting. We've discussed the flooring. What else?
So also blinds are important too. So blinds, they've got quite a low effective life as well. Blinds and curtains, so they've got a bit of a different depreciation rate between the two, but the important thing is that they also have quite a low effective life. So it's below 10-year period as well, and those assets, you know, it does aesthetically help the property, but the dollar value there also is quite significant. And also aircon units too. So aircon units, I usually do mention them too, but it does depend on the dollar value that you have, because you can understand, Anmol, you can have like a split system aircon that might cost about $2,000-3,000 to install, and it can range up to a ducted aircon system, which is like $15,000 to $20,000. So
exactly.
So they also have a low depreciation or effective life, and they're usually very bang for your buck too. They're the highest depreciable asset that you can invest in, actually.
There you go. Perfect. Well, lots to learn there, and I'm sure there's lots of other questions as well. So while we are live, if you do have any questions, do feel free to send them through. I'm not too sure why I can't see the Facebook comments, but even if we don't get around to it while we're live, we will be responding to you afterwards. So stay tuned for that. And on Instagram, we are live, so you're welcome to ask any questions while we're talking through. So let's continue. So what else can we expect in terms of tax deductions? What else should we be looking out for?
Yeah, so Emma, one of the important thing I think, especially with yourself in real estate and myself in quantity surveying works, is that we ask for expenses quite a bit.
Yeah.
And we always ask for expenses because sometimes it does relate to the depreciation report of property investors. And so there's three types of expenses that you can have. It can be a maintenance cost, a repair cost, or it can be an improvement cost. So when you have a client, when I have a client, they say they've installed a brand new aircon unit, that's when we can definitely help with claiming depreciation, because it's an improvement of the property, or it's an additional asset into the property. So you can claim depreciation on that. But Anmol, the funny thing is that they do sometimes advise that the aircon unit had it was maintained, or they had someone come out and clean it, or yeah, there was a pipe that was broken out back. Those are unfortunately not claimable in depreciation. So those would be, say, claimed as an expense or a repair cost. And those repair costs actually are immediately deductible. So it's important for people, if they've got property managers like yourself, making sure that the property is well looked after, that all the receipts you've got records of it for them, and they claim it with their tax agents.
Yeah, so that one piece of paper that you get at the end of financial year that shows what your income is versus expenses and what your net income is, that's basically all you need to be able to take to your accountant.
Yeah, exactly. And I think that's why it's really important to make sure you've got a good property manager, because all these expenses are accountable for. There's no need for you to keep receipts or, remember, oh, that invoice that I had from. Yeah.
And that's a good point, because we also encourage our clients to send us receipts if they've made purchases themselves, like it hasn't come from the rental received that into our trust account. We're still happy to keep the record in one place to be able to account for that expense, although they spent it, but we can keep that in one, so that you've only got one piece of paper at the end of financial year to take to your accountant, as opposed to, oh yeah, here's from my agent, plus all of these other receipts that I've spent out of my own pocket. So that's definitely something that is not a lot of people know, that you can send that through your agents to keep one place of record for all of those expenses with your investment property.
That's exactly right. So we get clients who say have done improvements in the past, and unfortunately, if they haven't held records, or they haven't kept all the receipts and invoices, we see this predominantly with clients who actually lived in the property, and it was like their dream home, so they never thought of moving out or anything like that. And they eventually do, and so there's no records available. So that's our job as a quantity surveyor. If they've done any renovations or improvements, that they can still capitalize and claim deductions on depreciation once they decide to lease out the home later on down the track.
Yeah, well, there you go. Any final words? Anything else that we haven't covered?
I just think, thanks for having me, Anmol.
I think even before you go, just so that some people, the previous session that we had was all about depreciation schedule. So for those of you that have access to a podcast, you can go back to that one as well, that episode as well. But just to give an overview, just for those people that don't know what exactly that is, do you want to just give us what exactly is? I remember your example very clearly, when you tip a house upside down, whatever comes out is what can be used. So tell me that reference again.
Yeah, so I use the analogy, depreciation is on a property is like when you buy a brand new car from a dealership, and you buy your car for a certain amount, but the minute you drive your car out of that dealership driveway, it's already started losing value. And so the same analogy applies to a house. The minute that you settle on a property, your value of the building only, it's got nothing to do with market value, just the building will start to depreciate over time. And so depreciation works with two factors. There is what's called capital works, and there's plant and equipment. And plant and equipment is basically what happens when you pick up your house and you flip it upside down, and there's nothing that is actually glued to the actual walls themselves or fixed to the walls. If they're not attached to the walls, that is a fixture and fitting, basically. Anything else like windows, walls, doors, cabinets, those are all classified as capital works. So different depreciable life. So the ones that all drop out, they all have different life expectancies or effective life.
There you go. Perfect. Well, thank you so much for sharing that and coming online once again. If there are any other questions, we're happy to answer them afterwards as well. Thank you very much. We'll see you next time.
Thanks, Anmol. Thanks so much for having me.
See ya.